Hey guys, what's up? It's Collins here, and listen, I know a lot of you are looking to make your money work harder in 2025. You see that number, £100? It's not just about saving it, it's about making it grow. And today we're diving into the world of stocks. But don't worry, we're doing it the smart way. I'm breaking down everything you need to know, from picking the right investments to understanding the risks involved. So if you're ready to turn your spare cash into serious gains, stick around because this video is for you. Want to turn your £100 into something big in 2025? Let's talk about stocks the smart way. Alright, let's kick things off with the classic strategy, buy and hold. This one's all about playing the long game. We're talking years, even decades. Buy shares of a company you believe in and hold on to them. Think of it like owning a piece of that company. But what about the market ups and downs? Those definitely happen. But with buy and hold, you're not trying to time the market, you're riding out those fluctuations. History shows the market trends upwards over the long run. The beauty of buy and hold is its simplicity. You're not constantly buying and selling, you're in it for the long haul. Compounding is like a snowball effect, generating more returns over time. Choose companies with a strong track record and bright future. Do your research and make sure it aligns with your goals. It's about building wealth steadily over time. Diversification is your friend. Don't put all your eggs in one basket. Spread your investments across different companies and industries. This helps to mitigate risk. Buy and hold might be your ticket to financial freedom. It's all about patience, consistency, and compounding. Let's talk about another great option, especially if you're looking for some passive income. Dividend stocks. These are like the gift that keeps on giving. Imagine getting paid just for owning a piece of a company. That's what dividend stocks are all about. Here's how it works. When you buy dividend stocks, you're investing in companies that share a portion of their profits with their shareholders, typically on a quarterly basis. It's like getting a paycheck from your investments, and who doesn't love a little extra cash flow? Now, not all companies pay dividends. Some choose to reinvest all their profits back into the business for growth, which is totally cool too. But dividend paying companies are typically well established, profitable businesses with a history of sharing their success with their investors. Think of it like this. You buy a rental property and every month you collect rent from your tenants. Dividend stocks are similar. You're essentially a part owner of the company and you receive your share of the profits in the form of dividends. The beauty of dividend stocks is that they provide a steady stream of passive income that you can either reinvest back into your portfolio or use to cover expenses, fund your lifestyle, or even treat yourself to something nice. But here's the thing. Dividend yields can vary widely, so it's important to do your research and choose companies with a solid track record of paying dividends consistently and even increasing them over time. Look for companies with a sustainable dividend payout ratio, meaning they're not paying out more in dividends than they can afford. And remember, diversification is still key. Don't put all your eggs in one basket, even if it's a dividend paying basket. Spread your investments across different companies, industries, and sectors to minimize risk and maximize your potential returns. Now, If you're feeling a bit more adventurous and have a higher risk tolerance, growth stocks might be right up your alley. These are the companies that are disrupting industries, innovating like crazy, and growing at a rapid pace. Think tech giants, emerging biotech companies, or even that cool new electric vehicle startup everyone's talking about. Growth stocks are all about potential. They're not necessarily focused on paying dividends, at least not yet. They're all about reinvesting their profits back into the business to fuel even more growth. And when these companies succeed, their stock prices can skyrocket, potentially delivering massive returns to investors. But here's the catch. Growth stocks are inherently riskier than their more established counterparts. They're often volatile, their valuations can be high, and their future success is far from guaranteed. Investing in growth stocks is like betting on the next big thing. You could hit it big or you could strike out. So, how do you navigate the exciting yet potentially treacherous world of growth stocks? First and foremost, do your homework. Understand the company's business model, their competitive landscape, their management team, and their growth prospects. Look for companies with a clear vision, a strong track record of innovation, and a massive potential market. And remember, diversification is your best friend, especially when it comes to growth stocks. Don't put all your eggs in one basket, no matter how promising that basket may seem. Spread your investments across different companies, industries, and sectors to mitigate risk and increase your chances of success. Growth stocks can be a wild ride, but they can also be incredibly rewarding. Just remember to invest wisely, manage your risk, and be prepared for some volatility along the way. Let's shift gears and talk about a passive yet effective investment strategy: index funds and ETFs. If you're overwhelmed by researching stocks or timing the market, this is for you. Index funds and ETFs are the ultimate set it and forget it investments. They let you invest in a diversified basket of stocks or bonds that track a market index. Think of it like buying a tiny slice of the entire stock market pie. You're investing in hundreds of companies at once, diversifying your portfolio and reducing risk. Index funds and ETFs are low cost, easy to buy and sell, and require minimal maintenance. You're not paying high fees or spending hours researching stocks. You're investing in the market as a whole and benefiting from its growth. You might think, won't I miss out on big winners? True, you won't see explosive growth like individual stocks, but you also won't be exposed to the same level of risk. Index funds and ETFs are about slow and steady wins the race. They're designed to provide market-matching returns over the long term. Diversification is built right in, so you're not putting all your eggs in one basket. For a simple, low-cost, and effective way to invest, index funds and ETFs are fantastic. Perfect for beginners and hands-off investors looking to build a diversified portfolio. Finally, let's talk about the titans of the stock market, blue chip stocks. These are the companies that have stood the test of time, weathered economic storms, and emerged as leaders in their industries. Think household names like Apple, Microsoft, Coca-Cola, or Johnson & Johnson. Blue chip stocks are like the bedrock of the stock market. They're typically large cap companies with a long history of profitability, a strong track record of paying dividends, and a reputation for stability and resilience. They're the kind of companies you'd feel comfortable owning for the long haul, knowing they've navigated their fair share of challenges and emerged stronger. Now, blue chip stocks might not offer the same explosive growth potential as some of the younger, more agile companies out there, but they provide a sense of security and stability that's hard to beat, especially in uncertain economic times. They're like the anchors of a well-diversified portfolio, providing a solid foundation for long-term growth. And here's the thing, many blue chip companies are also dividend aristocrats, meaning they've consistently increased their dividend payouts for 25 years or more. That's a testament to their financial strength and their commitment to rewarding their shareholders. Investing in blue chip stocks is like owning a piece of the American or global dream. It's about aligning yourself with companies that have shaped industries, innovated, and delivered value to generations of consumers. But remember, even blue chip stocks aren't immune to market fluctuations or economic downturns. Diversification is still key. Don't put all your eggs in one basket, even if it's a blue chip basket. Spread your investments across different companies, industries, and sectors to mitigate risk and maximize your potential returns. So there you have it, your crash course in stock investing for 2025. Remember, the key is to start early, invest consistently, and stay informed. Whether you're just starting out with a few £100 or you're a seasoned investor, there's always something new to learn and new opportunities to explore in the world of stocks. The most important thing is to take action and start building your financial future today. Like this video, hit subscribe, leave a comment, and share with someone who wants to grow their money in 2025.